What is up, guys? D Chantilly here, and I want to let you know that this video was recorded prior to the IPO of Duck Creek Technology, so keep that in mind with some of the IPO numbers that you are going to see. Hope you guys enjoy the video. Like, comment, and subscribe if you do. See you next time. What is up, guys? D Chantilly here, and today we're going to be discussing Duck Creek Technologies. And if you're like me and didn't know what Duck Creek Technologies was, it's a leading provider of core system solutions and professional services to the property and casualty and general insurance industry. Some of their customers include Geico, Progressive, AIG, Berkshire Hathaway Specialty Insurance, and Markel. Now, Duck Creek does not have a set IPO date, but we do have a lot of information. They will be selling 15 million shares at an expected price between $19 and $21 a share, and they're expecting to raise between $285 million and $315 million from this IPO, and I believe they're expecting a valuation of about $2.6 billion. And so now we're going to take a look at Duck Creek Technologies, or Duck Creek as I may call them going forward in this video. And we're going to take a look at their financials, risks, some of the competitors, and determine whether or not this can be a successful company on the stock market. And so Duck Creek Technologies is a SaaS company, also known as a software as a service company, and Wall Street loves SaaS companies, mainly due to the fact that when you sell your product as a service, you'll see recurring revenue because customers are repeatedly buying your products. When you think of a SaaS company, think of Microsoft. When you pay monthly or yearly for their Microsoft Office, think Adobe, QuickBooks, where you pay monthly or yearly for their accounting tools. Those are SaaS businesses. And Duck Creek offers very useful products to their customers, and they are very creatively named. They have Duck Creek Billing, Duck Creek Claims, Duck Creek Insights, which is an insurance analytics tool, just to name a few of their products. And so as we can see, their products are very useful and encourage customers to stay within the ecosystem. As you see, we have claims, billings, and insights, all within the same company, all under the same ecosystem, all using the same suite of products. And so when you look at Duck Creek, they have useful products on the SaaS model, big and established customers. So what are some of the risks to this business? In their S1, they obviously brought up the pandemic. We have to allow them to bring up the pandemic. That's a free one. But they also mentioned the pandemic could lead to customer favorite contracts. And the quote, the company said, the related impact on the global economy could also decrease technology spending by our existing and prospective customers and adversely affect their demand for our solutions. Further, our sales and implementation cycles could increase, resulting in providing contract terms more favorable to customers and potentially longer delay between incurring operating expenses and the generation of corresponding revenue, or in difficulty accurately predicting our financial forecast. End quote. The company also stated, we have a history of losses and may not achieve profitability in the future. Don't really let that scare you out of investing in a company. Every company kind of has to say that, especially if they're not profitable when they go public. Duck Creek is a growth company, and they're going to have to spend somewhat aggressively to gain a larger customer base and improve their current software. And then they mentioned competition, and this is where it could scare off a few people. In the IT service field, they named the Hewlett-Packard spinoff DXC Technology. In the property and casualty insurance field, they mentioned Guidewire and Insurity. And in the horizontal software vendors, they named Oracle and SAP. In the HSV, or horizontal software vendors, caters to the business's needs. When you think that, think QuickBooks for accounting and Salesforce for customer relations management. And so we can tell just by hearing those names and the fields that they're competing in that the competition is legitimate for Duck Creek. And they're going to have to continue to increase their product offerings, the value add of their product, in order to maintain the current customer base they have, because they do have big and established customers. And with all that being said, let's move on to their financial data. And we're going to be looking at their pro forma numbers. And we're going to start with their unaudited pro forma consolidated statements of operations for the 9 months ended May 31st of 2020. And when we look at their revenue, it comes from four main separate sources: the subscription, license, maintenance and support, and professional services, the largest being professional services, followed by subscriptions. And when you look at that, it totaled $153,350,000 for the quarter. The cost of revenue cost about $67,532,000 for the quarter, giving them a gross margin of about 55.9%. And then when you take into consideration the total operating expenses, it brought the net loss from operations to about $7 million, and the total net loss for the 9 months ended is about 8.4, almost $8.5 million. And then when we take a look at that year over year versus the same time period of 2019, total revenue was up 24.31%. The cost of revenue was up 30%. Total operating expenses was up about 11.7%. But the operating loss came down about 39%, and the net loss is better by about 39.93%, or really almost 40%. And now let's move on to the balance sheet, and this is the unaudited pro forma balance sheet as of May 31st, 2020. And the one you're looking at is abbreviated. I took some things out just to keep it from being so, convoluted in a lot of things. So let's just focus on some of the things that we may deem important. And so when we look at the cash and cash equivalents, they have about $215.9 million, accounts receivable about $29.6 million, and total current assets of about $269.5 million, and total assets of $693.588 million. And when you look at their liabilities, it's not much. $911,000 of accounts payable, accrued liabilities of about $39.9 million, total current liabilities of about $72.6 million, and total liabilities of about $100 million. And so as you can see, there's not a whole lot of liabilities for this company, which is a very positive sign. And when you look at their ratios, their current ratio, which is the current assets divided by the current liabilities, a good current ratio is usually between 1.2 times and 2 times. This company has an 11x, which could mean they're not leveraging their assets efficiently, but I'm not going to complain about a debt-averse company. And so in conclusion, I am satisfied with what I saw from this company in the S1, but I'm not going to rush into the stock. I'm not really heavy into jumping into IPOs. I think the only IPOs I can think of where I jumped in relatively early would be DraftKings and Moderna. I think that's probably the only 2 IPOs I just jumped into, not on the first day, but within the first month or so. And so I really want to watch how this company reacts once it goes public. We're going to get a date and all that, and see how it acts in the public market before jumping into it, so I can see more related information about the company going forward, more forward-looking statements. And so I hope you guys enjoyed the video. Let me know what you guys think down in the comment section below. I look forward to reading your comments. See you there.